Hello, everybody. My name is Edison Tian, and we are in Group 5, presenting Bank of America's financial standings based on their annual report. Now, Bank of America is an international financial organization that offers a variety of banking service and financial services to people and of different firms. The Bank of America, which was established in 1904, has developed into one of the largest financial institutions in the world, operating in more than 35 countries and territories. They offer a whole spectrum of financial products and services, including commercial banking, investments, wealth management, management services, and a lot more. It has a network of more than 4,300 outlets and employs over 200,000 people. The bank is committed to supporting community development and economic prosperity while also aiding its clients and customers in attaining their financial goals. The Bank of America is a pioneer in the financial sector, renowned for its cutting-edge approach to banking, as well as its dedication to its sustainability and social responsibility. Now, being one of the largest firms and financial institutions, naturally, Bank of America is also a publicly traded company listed on the New York Stock Exchange and NASDAQ stock. In order to assess the financial position of this company, this research paper will conduct a vertical and horizontal analysis on Bank of America's most recent financial report. Afterwards, this paper will calculate the financial ratios of the company and cross-compare them with the competitors in its industry, which will come right after me.
Hello, my name is Francis Hernandez, and today I will be presenting an overview of Bank of America consolidated income statement for the year of 2021 compared to the previous year. Interest, income, and expenses. In 2021, Bank of America interest income decreased by 3,900,000, or 7.5% compared to the previous year. This decline was accompanied by a decrease in interest and expenses, which amounted to 3,400,000, or 4.2%. Consequently, the bank's net interest income experienced a slight decrease of 1.0% of $426 million. For the non-interest income, Bank of America witnessed a positive growth in non-interest income during 2021. Fees and commissions increased by $4.7 million, or 13.7%, indicating a rise in the revenue from these resources. Revenue from market making and similar activities also saw a modest increase of $336 million, or 4.0%. In conclusion, Bank of America consolidated income statement for the year that ended in December of 2021 reflects a mixed picture of the financial performance. While interest income and net income experienced declines, non-interest income, particularly fees and commissions, show significant growth. Overall, Bank of America reported a significant increase in net income, highlighting its ability to adapt and thrive in a dynamic market. Now we will move on onto the vertical analysis. We will examine the percentages of various line items in relation to the total revenue and total expenses, providing an insight into the company's financial performance. Interest and income expenses. In 2021, interest income represented 111% of the total revenue, indicating a slight decrease compared to the previous year of 2020. Interest expenses accounted for 11% of the total revenue, reflecting a decrease in cost. As a result, net interest income remained stable at 100% of the total revenue. Non-interest income. Bank of America experienced growth in non-interest income in 2021 compared to the previous year of 2020. Fees and commissions constituted 85% of the total revenue, reflecting an increase in revenue from these resources. Market making and similar activities accounted for 18.8% of the total revenue, indicating a modest increase compared to the previous year. However, other income represented minus 3.8% of the total revenue, signifying a loss in this category. Overall, non-interest income accounted for 100% of the total revenue. Operating expenses. The bank's operating expenses vary in different categories. Compensation and benefits constituted 60.5% of the total expenses, reflecting the bank's focus on human resources and employee development. Occupancy and benefits accounted for 12% of total expenses, while information processing and communication represented 9.7%. Product delivery and transaction related expenses constituted 6.5% of total expenses. Marketing and professional fees represented 3.2% and 3.0% of total expenses. And other general operating expenses accounted for 5.1% of the total expenses. In conclusion, the vertical analysis of Bank of American income statement provides insights into the company's financial performance. Operation expenses vary across different categories, with compensation and benefits being the largest expenses. This analysis helps us understand the composition and proportions of different financial elements within the company statement.
Bank of America's total assets added up to 3,169,495 in the millions in 2021. Total liabilities added to 2,899,429 in the millions, with shareholders' equity adding up to 270,066 in the millions, resulting in total liabilities and shareholders' equity adding up to 3,169,495 in the millions. There was a 12% increase from 2020 to both total assets and total liabilities and shareholders' equity, as it was 2,819,627 in the millions during the year 2020. Bank of America states that this increase is primarily due to higher debt securities that were primarily funded by deposit growth. This can be understood as debt securities had increased by 43,000, the largest out of all the assets, adding an extra 297,777 in the millions to total assets. This debt securities increase was a result in Bank of America seeing an increase of 2 million digital users in 2021, as they say it is the highest growth they have seen up until that point. And similar to debt securities, seeing a large nominal increase was deposits, which also can be tracked back to the fact that there was an increase of 2 million digital users, which totaled 54 million in 2021. Current assets had increased by 17% in 2021, which is matched by current liabilities increasing by 60% in 2021. The increase in current assets and liabilities was most influenced by the increase in debt securities and deposits. However, current assets in 2021 added to 1,828,648, while current liabilities added to 2,381,218. This represents that the company is not as liquid as it should be, as current liabilities exceed current assets and will be discussed later on. In 2021, current assets made up 57.7% of total assets, whereas non-current assets made up 43%. Debt securities made up 31% of all assets in 2021, while it was only 24.3% in 2020. Again, as stated by Bank of America, due to the increase in digital users. The second largest asset was at 30.9% was loans and leases, which is a non-current asset. This means that Bank of America is going to have to wait at least 1 year or an accounting cycle before it matures and they are able to use those assets as a current asset. Liabilities made up 91.4%, and shareholders' equity made up 8.6% of total liabilities and shareholders' equity. Liabilities made up a large portion, mostly due to deposits, which represented 65.1% of the total in 2021. 2020 also saw deposits representing the most of total liabilities and shareholders' equity at 63.7%. Current liabilities made up 75.1% of the total in 2021, representing that the company may have to pay a lot back within the next year or accounting period. Shareholders' equity only made up 8.6% in 2021, which decreased from 2020, in which it represented 9.7%. This decline may represent a scare to shareholders and will be discussed later on.
Here we have the liquidity ratio, and what the liquidity ratio is a type of financial ratio that is used to determine a company's ability to pay its short-term debt obligations. According to Bank of America's annual report, their current assets summed up to 1.8 million, while their current liabilities summed up to 2.3 million during the year 2021. This resulted in their current ratio being 0.77 to 1. In 2020, their current ratio was 0.76 to 1, resulting in the bank having a slightly better liquidity after 1 year. However, the bank is still not very liquid as there are more liabilities than assets. According to Bank of America's asset test or quick ratio, in 2021, their ratio was 0.59 to 1, as cash, short-term investments, and net receivables summed to 1.4 million. In 2020, the ratio was 0.55 to 1, presenting a slight improvement between the years. Up next, we have profitability ratios. And the profitability ratio is a financial metric that is used to assess a business's ability to generate earnings relative to its revenue. According to Bank of America's reports, net income in 2021 was 31.9 million, with net sales being 89.1 million. This resulted in a profit margin of 36%. In 2020, the net income was 17.8 million and net sales were 85.5 million, with a profit margin ratio of 21%. There was a 15% increase in profit margin, representing a significant increase in profits relative to their cost. Average assets are calculated as total assets of the current year plus the previous year divided by 2. This results in average assets being 2.9 million in 2021 and 2.6 million in 2020. Calculating the asset turnover in 2021 to be 0.003%, with 2020 being 0.033%. This represents a decrease in asset turnover between 2 years. According to the Bank of America, the return on assets is 1.5% in 2021 and 0.67% in 2020. According to the Bank of America, again, the return on common stockholders' equity is 12.23% in 2021 and 6.76% in 2020, representing a nearly double increase between the years. This represents a large increase in stockholders' investments between the 2 years. The Bank of America also indicated that their market price per common share is $44.49 and 49 cents and $30.31 in 2020. This resulted in the price earning ratio to be 12.36 in 2021 and 16.12 in 2020. The price earning ratio had decreased, meaning that they pay less for each dollar earned. This represents that the company was more in favor for shareholders in 2021 compared to 2020. The payout ratio is calculated as cash dividends divided by net income. Bank of America reported a cash dividend of $8,055,000 in 2021, resulting in a payout ratio of 0.25 to 1. This is a significant decrease from 2020, which had a ratio of 0.43 to 1. Next, we have the solvency ratio. And what solvency ratios are is it measures how well a company's cash flow can cover its long-term debt. The total debt is the sum of current liabilities and long-term debt. Bank of America reported liabilities and long-term debts is 2.3 million and 280 million in 2021 and 2.05 million and 262 million in 2020. This resulted in a debt to total assets ratio of 0.84 in 2021 and 0.82 in 2020. Bank of America's income before taxes and interest expense in 2021 was $93,851 and 93 million $753,000 in 2020. This resulted in the times interest ratio in 2021 being 19.81 to 1. This is a significant increase from 2020, which had a ratio of 11.40 to 1, presenting that the bank was less risky in 2021 and had improved insolvency. And that brings us to our unique ratios. The net interest margin is calculated as a difference of interest expense or cost from interest income divided by total assets. Bank of America's consolidated income statement reported a net income of $42,934,000 in 2021 and $43,360,000 in 2020. This resulted in a net interest margin of 0.014 to 1 in 2021 and 0.015 in 2020. This signifies a net profit on interest earning assets to be relatively the same for both years. Bank of America reported a net income as $31.9 million in 2021 and $17.8 million in 2020 in their consolidated statement of income. This resulted in a return on assets ratio being 0.01 in 2021 and 0.006 to 1 in 2020. The loans to asset ratio measures bank dependence on interest-bearing loans. According to Bank of America's balance sheet, the bank had loans and leases net of allowance valued at $966.7 million in 2021 and $909 million in 2020. This resulted in the ratio being 31% in 2021 and 32% in 2020. The bank relied on loans relatively the same amount in both years.
JP Morgan Chase is the result of a series of mergers and acquisitions, including acquisitions of Bear Stearns, Bank One, and Washington Mutual. In terms of liquidity, we looked at two aspects, current ratio and quick ratio. As Anthony said, the current ratio is the short-term debt paying ability of the said bank. The problem with the quick ratio is that Chase does not include much of their said inventory, which is hard in order to calculate its quick ratio. From recent results of 2021, the quick ratio has not deviated dramatically from the average, indicating consistency. However, the number indicates that JP Morgan Chase would struggle to settle its debts from the sale of current assets and would need to resort to other means. Profitability ratios to assets, a business income generating ability compared to its assets, revenues, operating costs, and equity. The ratios depend on data from a specific period. Profitability ratios are closely related to efficiency ratios that look at how well a company utilizes its assets internally to generate earnings. We can clearly see that Chase is right behind Bank of America and TD. Within the profit margins, all banks are close, but the asset turnover rate, Chase, is approaching fast due to their series of acquisitions, as mentioned before. Their net margin increased from 2017 to 2019, but decreased in 2020, probably due to COVID-19 economic crisis. Overall, Chase did take a hit in the 2020 health crisis, which dramatically affected all their aspects of profitability. In terms of solvency, these ratios measure an organization's ability to meet long-term and debt obligations. It measures the financial health of an organization by gauging whether its cash flow can meet its long-term liabilities. For JP Morgan Chase, the ratio is consistently above 1, meaning that the company consistently has a higher debt than equity. This figure indicates that the company could have problems covering its debts if it were to liquidate. The numbers indicate that the company had fractional debt compared to its assets.
When we begin comparing Bank of America to one of its competitors, TD Bank, we first start looking at the liquidity ratios. The two liquidity ratios that we'll be focused on are the current ratio and the quick ratio. The current ratio measuring the short-term debt-paying ability of TD Bank, and then the quick ratio measuring the immediate short-term liquidity, or essentially the cash on hand to pay any immediate debts. When comparing financial statements for both TD Bank and Bank of America, we see that TD Bank is substantially more liquid in both ratios than that of Bank of America. Without further research, there's a potential that the substantial difference is due to the Canadian legislation being different than that in the United States, forcing TD Bank to hold much more of its cash assets back for debt paying purposes. We then look at the profitability ratios, which indicate both how profitable the company is based on its assets, as well as how profitable the company is for investors. When we look at the asset-based ratios of profit margin, asset turnover, and return on asset, we see that Bank of America is actually carrying a higher profit margin, a higher asset turnover, and a higher return on asset than that of TD Bank. This difference, although it could be operational, could also be attributed to a difference in legislation, again allowing Bank of America to leverage itself further, thus making a larger profit over the assets that it has. When we look at TD Bank's profitability for investors, we see that they have a slightly higher return on investment, as well as a slightly higher earnings per share. Rather than profitability based on asset, these two ratios are directly related to the profitability based off of equity investment. When next comparing the price earnings ratio, we see that TD offers a higher return per cost of share relative to Bank of America, and then also having a substantially higher payout ratio, indicating that they are distributing a much higher portion of their earnings as cash dividends. We then compare the solvency ratios, which are directly related to how much of their assets are being attributed to creditors. We see that TD Bank has a substantially higher debt to total asset ratio than Bank of America, indicating that they are much more reliant on their creditors, but they also have a substantially lower times interest earned, indicating that they potentially could be at a more precarious position when trying to meet the interest payments to these creditors.
With all the finances and ratios taken into account, there are some major differences between Bank of America Corporation and its competitors. Bank of America has a debt to total asset ratio a little lower than TD Bank and much higher than Chase Bank. Bank of America also has more liabilities than their assets, making their financial standings not the greatest. Bank of America had the highest times interest ratio out of the three banks. This represents Bank of America had the best ability to pay interest payments as they were due, and had the least amount of risk to investors, making that one the pros, lower risk. Other than interest payments and risk, Bank of America Corporation holds no other major advantages over its competitors.